Good afternoon, everybody. Welcome back to cilinixfxcapital, or welcome to the channel if you're new, and welcome to a new trading education video. It's been a very long time while I adjust my camera real quick right here. It's been a long time, but I had some ideas about some education that I wanted to share with you, and that I think can be very useful for all of you as well. So that's what we'll talk about. And the main topic of this video is finding liquidity zones, all right? So liquidity zones, in this case, we'll focus on them by using point of controls. If you watch my videos very often, you hear me mention POCs or point of controls very often. They're grade levels, all right? Basically what point of controls are, which is what I wanted to start off with. And then we'll talk a little bit about how to calculate POCs, how to find them, how to actually put them on your charts. Which we'll talk about two ways. One main way in which I use them, and one a little bit more difficult way to find them, but still possible. We'll talk about why it's important. So basically how you can use it in analysis and trading. And then we'll talk about some reactions to the POC, to the point of control area, which is usually one price area, right? What certain reactions to that level mean for the price and for the strength and for the trend of a certain coin. So that's what we'll talk about. So let's get right into it. First of all, like I said, what I wanted to start off with is by talking about what is a point of control, right? So a point of control, usually I refer to it as a POC. It's very simply said within a certain time range, but you can also, well, no, it's always within a certain time range. So let's say in the last 3 months, the POC, the point of control, is the price at which the volume was highest. All right, so basically where most transactions took place. That is very simply said what the POC is. Now then there's different ways to talk about that. Now, first of all, the POC always has to do with volume, right? Volume is the main component of the POC. If we don't know the volume, we don't know where the POC is, right? And then it's basically volume divided over certain ranges of price, and then which range of price most volume occurred in. That's the POC. All right. Now there's two different ways to find POCs. First of all, you can have a VRVP, so a visible range volume profile. That's what you can see here to the left, right? So those are those blue bars. And that basically the entire chart you can see on the screen, it calculates, all right, at how much volume was there at each level, right? So you can see these bumps and you can see these valleys right here. If there's a bump like this, a lot of volume was transacted there. If there's a valley, not a lot of volume was transacted there. So one way you can find POCs is basically these edges, right? You can see these normal distributions of price action. And then the POCs are in the middle, right? So it calculates for me the ultimate POC, so the area where most volume has been transacted. In this case, that's the yellow line at 96,300. As you can see, functions as resistance. Right here. So you can already see the first example of how to use it, because that is essentially what POCs do. All right, they provide support and resistance. The thing is that it's not as clear cut as that. All right, sometimes it will provide a lot of support or resistance. Sometimes it won't. Sometimes it will spike to that level, instantly reverse. Sometimes it won't. So it's not something you can use without anything else and then just rely on that, but it still can help a lot. All right. So yeah, that's one way how you can find them. And then you can also use, if you go to TradingView, here to the left, which I'll disable the overlay. You know I have a signal group down in the description. But if you go to the fixed range volume profile, you can basically do this, right? So if you see a consolidation, a period of time where the price, kind of moved sideways, such as right here, you can drag the fixed range volume profile, and it will give you the POC in the middle as well. So in this case, the POC is at 83,260. That's the point of control of the price action between the 9th of March until the 21st of April. And what I usually do is I drag a line, because this is still relevant for the price action now as well, because we know historically, and that's also visible right here from the VRVP, that a lot of volume was transacted there. So therefore, that's an important, in this case, demand zone we can expect a reaction from. So that is essentially how you can find POCs and what they are. Now, there's different types of POCs. In this case, like I said, we're only talking about, we're talking about POCs very generally. You have naked POCs. You can also have session POCs. You can have daily POCs, which I use as well. But if we were going to talk about that, this video would be 30 minutes long, which I don't think I don't think most of you would be interested in such a long video. I would much rather make a new video on session POCs, for example. But now the question, why is it important? All right, why is this area where the volume was highest important? And there's multiple reasons for that. First of all, it works as a bit of a magnet. Very often if we have these major POCs, so in this case, major POCs in my eyes are 96,000 and 83,000. Normally they work as a bit of a magnet. So the price tends to shift between those POCs and the area around it. So in this case, that also happened, right? I mean, we had this POC up here, price shifted to that. And now you could argue that there's a bit of a magnet to this POC to the downside. So that brings an added confluence as to why you would expect some bearish price action. But there's also a POC probably right here. If you take this price action right here, there's also a POC a little bit higher towards 105,000. So it's never as clear cut, right? I mean, you can also see a bit of a spike here. We could also, from the current price action, depending on how we react to that POC, move up to this naked POC here at the top. But in general, they work as a bit of a magnet, and the price tends to shift from POC to a different POC historically. But then outside of that, it's also a great area for whales, all right? Because very often the POC also signals where most of the liquidity is, right? So what are the areas where whales exit their shorts or enter longs because they want to enter with size or exit with size? It's at these POC levels, all right? So very often for that reason too, they're not only a magnet, but there's also a relatively high likelihood that we see a reaction from that and a reversal, possibly. Not always the case. But like I said, the reaction to that POC matters a lot, because the main way you can use this in trading is as resistance, as support, and also as a bit of guidance of where the price can go next, so that you have a bit of an idea of, all right, well, I know the next POC is right there. So I can expect to set my TP towards that zone, right? So then you can know the potential reward you have. And that way you can also more easily calculate the potential risk that you can take with a trade. But that's the main way to use it is as demand or supply, right? Or resistance and support. However, the reaction to a POC can tell you a lot as well, all right? Because usually what is true, and this is a very general comment, but it will help you. Usually what's true is that a strong reaction to the POC, so let's say, for example, hypothetically, that the price starts to move down right here, and this was the top, and we start to trend down. If we get a strong reaction to this level at 83,200, so we spike down into that and then instantly break back above this blue line, the value area high, then we're very likely to start trending up again, all right? So that way, a strong reaction to the POC signals a reversal in price. It works as a magnet. Price shifts between these POC areas. So it shifts from the POC area up here to this one down here. Strong reaction to that would signal a reversal back up to a POC a little bit higher. On the other hand, what could also happen is that we start to trend down here and that we get a weak reaction. So for example, that we are not able to break above this value area high right here at 86,000, but that we accept back into the range. That's bearish. Then profit has been taken there and some positions will be taken there, but then it's more likely will continue. And what's even more bearish is if we head down to the POC and we break down below that. That's the most bearish option, and then it's very likely we get continuation. So there's 101 ways you can use these POCs, but hopefully this serves as a good introduction, first of all, on what these POCs are and how you can use them in your trading and how you can set them. Hopefully that helps, but for now that's it. I'm going to make a market update. Thank you for watching, take care, and bye.